Welcome back to the What You More podcast. I'm your host, Quinton Harris. And on this episode, I've got a standing co-host, Dan Habib. If you have been listening to this show, you know exactly who Dan is. But if you don't, just a quick little update. Dan was recently named 40 under 40 mortgage professionals in the Rising Housing Award from Housing Wire. Dan also is the Chief Revenue Officer over at Highway, which is the parent company of MBS Highway and List Reports, which so many of you are familiar with. But also, he's the co-founder of Crypto Charge, a platform that's designed to educate investors on the crypto markets to help them kind of navigate those channels. All of that shows up in this episode because Dan's going to talk about why interest rates are what they are, but where they're going and why crypto can play a large role in that. Also, what's going on with the Federal Reserve and the two meetings that are coming up and why he believes rate cuts are on the horizon and scheduled to happen. And the last thing he touches on is real estate. Don't listen to the headlines because a wave is coming and it's for the positive. All of that and more in this episode of What's Your One More. Welcome back to the show, Mr. Dan Habib.
Brother, thanks for having me, man. Excited to be back. And boy, it's crazy how much has transpired since the last time I've been on.
Yeah, I mean, we've had a crazy job reports. We've had a little bit of headbutting at the Fed, maybe even a shadow Fed looming in the background there. We've had a pretty audacious Redfin report and what all of that means to our audience and more. So I'm excited to hear you talk about that and maybe kind of tease some rates and what's on the upcoming opportunities there for people that are looking for mortgages and refinances.
Yeah, well, you know, one of the things that we've been talking about is how the bull market for our industry, it's a lot closer than many people think. And boy, we've been seeing rates move lower until this morning where we kind of went in the other direction a bit. But I will say that the bond market, especially mortgage-backed securities, have really taken it somewhat in stride considering the report that came out. We got some inflation data, which is always important. And just 2 days ago, we got the consumer price index inflation report, which was okay. But we got the counterpart, the wholesale inflation report this morning. And that came out hot. It was up 0.9% for the month on both the headline and core. And that was a lot higher than the 0.2 expected. The year-over-year numbers jumped. Now, listen, everybody's been wondering, when are we going to see really the impact of these tariffs? Because in the U.S., I mean, you hear President Trump and the administration talking about how they're pulling in $29 billion a month. That's got to show up somewhere. You know, the person that's, or the country that is exporting that to us, they're certainly not paying the whole thing. Maybe they pay a little bit, but in a lot of cases that gets passed on. Our stance has always been that it's going to increase prices, temporarily so, because they're most one-time price increases. But the impact on the consumer, we always felt, would be less than people feared. Now, don't get me wrong. There's definitely going to be an impact. However, we always felt that it was going to be shared, because remember, you import something in here, you have your distributor, you have your wholesale, you have your reseller, and then it goes to the consumer. We always felt that it would be shared along the line and that wouldn't fully be passed on to the consumer. And I really think the last two reports that we got, the consumer price index and the producer price index this morning, really echo and illustrate that, because you had the consumer price index report for the same month really not be too out of whack and come in pretty close to estimates, but then the producer price index was much higher. What does that tell you? It tells you that the producer side of things, the wholesale side and such, is absorbing a lot of those costs. Now, right. One of the things that was feared is, well, what happens with the Fed's favorite measure of inflation, PCE? We get that at the end of the month. Well, we know the consumer price index numbers were okay, but there's shared components between the producer price index and the Fed's favorite measure, personal consumption expenditures. I'd say about the influence is around 12%. So it's not insignificant. However, if you go in the line by line items, the ones that are shared between both reports, they were actually pretty tame. So I'm not that fearful that that's going to cause a really, really hot PCE report that's going to impact things to the downside, at least seriously so at the end of the month. But I was, surprised. I mean, you see a PPI report come out 0.9%. I would have actually expected a bit of a worse bond market reaction, but maybe they are looking through that. And they're also looking at both the CPI and PPI together, seeing that producers are absorbing a lot of the costs, and also that those shared components, well, they weren't so bad. They were actually pretty tame. Now, Quinn, wanted to just kind of share for your viewers, because I always think they might think that this is interesting, production numbers and how many loan officers there are in the country active right now. So I think we have the best data out there for this. And our criteria is that in order for us to count you as an active originator, you had to have closed at least one loan in the last 4 months. How many people fit that? 174,000. Now, it's clearly come down from some of the numbers we were at several years ago. So a lot of your competition has kind of left the business, left the wayside, but it's been tough. I don't have to tell most of you listeners that are living and breathing this every day. It's been a tough environment. There's been a lot less activity. But here's where people stand, and I think this is eye-opening. If you want to be in the 50th percentile, that means half the people did more business than this and half did less. It's only 4.2 million over the last 12 months.
Wow.
Pretty tough, right? Now, if you want to be in the top 25%, it's a little less than $1 million a month in business. Top 10%, around $2 million a month in business. Top 5%, a little less than $3 million. And the top 1%, boy, a little less than $6 million a month. So it's a difficult environment. But as I said before, I don't think we're that far away from really seeing our business change. Obviously, one of the main catalysts there would be lower rates, and more than just a blip, lower rates on a sustained basis. So I want to just go over with you, a couple things here. So inflation, listen, it's going to be a little muddied in the short term by one-time price increases from tariffs. But if we look over the next 12 months, I do think we're going to see inflation come down closer to the Fed's target, around 2.2, probably more realistically 2.3%. That would help mortgage rates. But the labor market's going to be key. The labor market, we've been kind of beating the drum on this, Quinton, saying it's not as strong as people think. The Fed has been resting their cap on the fact that the labor market is solid. Because remember, they have a dual mandate. They can't ignore the labor market. Yes, they're fearful of potential tariff impact on inflation, but they've been feeling pretty safe to be patient and pause at the last several meetings because the jobs report from the BLS has shown a lot of strength. However, that's all changed. And again, we've been talking about this for a while because of the nature of the revisions, but all the other reports are showing weakness and not syncing up. Take a look at this. ADP, it's only had like 44,000 jobs over the past 4 months. And 2 months ago, it was negative 23,000. BLS all along was chugging along with high 147, 145,000 numbers. And we're like, this just doesn't make sense. And then you look at continuing claims. So when you lose your job, you get laid off, you file for unemployment benefits. And then if you continue to file for them, you get counted in continuing claims because you're continuing to receive benefits. This number has been just climbing. I mean, look at the chart here. And for 12 weeks in a row, 12 reports in a row, it's been above 1.9 million. In fact, it is right around the highest level since November of 2021. Why is this significant? And you have to remember, people can only, in most states, stay on benefits for 26 weeks. So this continues to climb as you have people's benefits expiring and they're falling off. And this is showing you that once you let go, you're staying on benefits for longer because you can't find a job because there's much less hiring happening. And the job opening.
To your point, that's people that have been on there for the last 12 months, basically continuing claims. But, it used to, didn't we change that number? Like, what was it? Well, then we used to measure that way beyond 12 months. Didn't that used to go well beyond that?
Continuing claims in most states, you can only be on there for half a year.
Half a year.
However, you're right, where after COVID, there was all kinds of extensions and such where you could be on there much, much, much longer. But that's been largely gone away with. It's usually about 6 months you could stay on these continuing benefits. But just look at the trajectory of what's happened with them. I mean, the number has really kind of gone a bit parabolic. And that's a sign to me that there's less hiring going on out there. And that's why they're staying on benefits longer. And there's less hiring partly because look at how much less job openings there are. I mean, we had a peak of like 12 million around May or so of 2022. I mean, that's down to 7.4 million. And I think this number is grossly overstated because what happened after COVID? You had work from anywhere. You could have this. And the way they count this stuff is on a state-by-state basis. So you could have the same job listed in 50 states and they're counting the same job 50 times if it's a remote work job. So I don't really buy this number. But either way, you can see the trajectory. But the big thing is, and what really helped mortgage rates to begin to come down was the jobs report. Now, we've been saying and criticizing the BLS because they've been overstating job growth only to revise it lower. And then much later, you get the QCEW data showing, guess what, last year, 50% of the jobs they said happened never did. They said there was about 2.5 million jobs. Now they revised that down to 1.25 million. I mean, that's not like a small miss. And if you remember last year, every time the jobs report came out, it just crippled us in the mortgage and real estate space because it caused rates to go much, much higher. Now, we've been frustrated about this. And clearly the administration's frustrated. They got rid of the head of the BLS. But before we get into that, let's get into the latest jobs numbers, because this was very validating for me, because it really underscored and showed that we've been correct on the labor market not being as strong. So the latest report for July, it showed 73,000 jobs created. The market was looking for 110. Clearly, this was a miss, but the true story was in the revisions. You had one of the largest in a long time revisions to 2 months of negative 258,000 to May and June. So what did that do to those numbers? Well, May was initially 144,000 and June was 147,000. That's the Fed saying, hey, look, the labor market's solid. However, now those numbers stand at 19,000 and 14,000 respectively. And guess what? There's one more revision that's going to come to June, and there's 2 more revisions that are going to come to July. And the average revision in 2025 after the 2 months is negative 77,000 per month. So if that pattern holds true, this number is going to be negative, and this one might be negative as well. So you certainly can't say the labor market is solid now, in my opinion. And here's the other thing. This year, even, we've been getting crushed by the BLS, because this year, and what I mean is hurting us with rates, because this year there's been so many opportunities where it looks like yields are moving lower on the 10-year, mortgage-backed securities moving higher. The table has been set several times this year for us to get under 6.5, get to lower rates, and then the BLS punishes us. If I like some shows out there like Marvel's The Punisher, okay? Well, the BLS has been the punisher of mortgage rates. And take a look what happened June 6th. BLS report comes out. We lost 52 basis points in mortgage-backed security pricing. The 10-year went up 13 basis points. July 3rd, we lost 71 basis points in MBS pricing. The 10-year went up 25 bips. So it has hurt us, and it's frustrating because we now find out those numbers were baloney.
And for our real estate agents, just to kind of let you know, what he's relating there is when that job report comes out in the manner it is, and those numbers he just shared, up 23 basis points on a 10-year treasury, that's literally like a quarter. That's like a quarter swing in rates. I'm talking to you at 6.5. Now I'm at 6.75 by the end of the day because of this report that, as you're describing, as a punisher to the market, that we're finding out is really more like the BS report, as we call it, right? Today's episode is brought to you by Texana Bank Mortgage. They're coming to the table with a revolutionary product. It's called REMLO, Real Estate Mortgage Loan Originator. And what they are doing is they are taking real estate agents and they're taking loan officers, and for the first time in history, they're putting them together under one umbrella. They're actually taking 2 industries right now that sit on top of each other, and they're putting them together and backing it by a full-service bank licensed in all 50 states. So imagine this. You're not just an agent anymore. You're a full-service agent. You're the single trusted point of contact for your client in this entire process. You're seeing the loan and the home search front to end. It's going to change the dynamic of real estate and mortgage lending together. Now, if you're a real estate agent, I want you to do me a favor. I want you to go to askaboutremlo.com. That's askaboutremlo.com. Because what you're going to find there are significant details about this program, how to enroll, and how to gather more information. So if you're ready to adapt and thrive, go to askaboutremlo.com. That's askaboutremlo.com. What do you think about getting rid of the BLS report altogether? Like just only use ADP, the private sector?
I don't think that's going to happen. I think it's important that we get a BLS report. It's just that we need to get one that is, you have to just think about it. The BLS, they really are in charge of 2 of the most important economic data points we get. The jobs report, you could argue, is the most important. Job growth in the economy really tells you a lot, and the unemployment rate to the health of an economy, and the markets react wildly to it. The Fed bases their monetary policy decisions on it, and it impacts all of us and everybody in a certain way. And they also have the consumer price index inflation report and the producer price index inflation report. So jobs and inflation, basically what the Fed bases all of their monetary policy on. Now, Yes, the PCE is a separate report from the BEA that comes out later, but because this one drops first around mid-month versus the PCE at the end of the month, and that's another inflation report, by the way, this one you could argue is more important because this one usually garners more of the market reaction because it comes first. We need these numbers to be right.
There you go.
And you can't have it be so important and have all of these decisions, whether it's investment decisions, the Fed decisions, you name it, be based on something that has such a high degree of error. Now, I understand that it's a tough job, okay? I mean, trying to get the job growth in the entire country in a timely fashion on a month-to-month basis, that's a behemoth effort. But the margin of error has been getting worse. And while it's been getting worse, there's also been more imputed data instead of hard data. They say they're understaffed. And it just boggles my mind how it's not like there was one report that was wrong. We're talking about consistently over the last several years. It has just been the same story, and they haven't changed their methodology. So based on that alone, okay, I don't like personally, and I don't want to get political, I don't like the approach that was taken where, we're talking about numbers being messed with. I think it's important to keep trust in our institutions. And I don't necessarily, listen, you never know in this world what's happening with things, but you don't have to even go there because there is more than enough warranted to make a change based on the consistent degree of margin of error and inaccuracies. Think about it like this, Quinn. I mean, if you're the manager of a baseball team or a sports team, and not only are you losing, but you're losing consistently and you don't make any changes, you're probably going to be held accountable. If you're the CEO of a big company and you're performing
100%.
poorly on earnings and then you consistently are doing so and you're not making any adjustments or changes, listen, people are going to make mistakes. Then you're going to probably be held under fire. And I think it's no different here. The head of the BLS was fired, Sarah Merkenturfer. And I hope I said that right, but McInturfer. But, I think that there was justification for making a change. Now, listen, we could get into if you agree with who was placed, Eric Anthony or in her place, or EJ Anthony, I should say. But all I want is to get some more accurate numbers because this number is so important. So I hope that some changes will be made. Funny enough, there's a text thread my father was showing me with, some of the who's who up there. And they actually were asking him if they wanted to throw his name in the ring for the next head of the BLS, but it wasn't something he was interested in.
Hard pass.
But obviously we break this stuff down pretty
Sure.
good and see. I mean, I could see several ways that you could improve this. I mean,
well, think about ADP. Wasn't it 2 years ago? They took a time out and said, hey, listen, we're copulating this. And it's not right. We're going to take 2 months off and get it fixed. I mean, what a great model.
Few months off to rework their methodology. And, there's been talks, maybe the BLS makes it a quarterly release, so it gives them time as opposed to this month to month. But they're using so much garbage data. One of the biggest skews is the birth-death ratio. Now, that's not like people being born or dying. That
I'm
is
glad you're clarifying this.
Coming online or offline, okay? And it is all imputed data. It's all based on trends from the last 5 years. Guess what's happened since then? You had COVID and such, it completely distorted everything. That's why I think part of the margin of degree for error is increasing, but also the response rates have been terrible. On the household survey where the unemployment rate comes from, it was like over 90%, and now it is like 60% or so. And then on the headline job creation survey, the business survey, it's a similar story with the rate of decline there. Listen, I mean, you and I are forced, if we get jury duty or something, to go ahead and do this. And they still use snail mail, by the way, with all of this data. Digitize it and enforce it. Make people have to fill this stuff out, or businesses have to fill this stuff out. I mean, this is important stuff. But also, you shouldn't have the largest weighting of the entire inflation report out there be owner's equivalent rent, which is where they call households and ask them how much they could rent their home for unfurnished and without utilities. Because guess what? You don't know the answer. I mean, I'm in this industry. If somebody were to ask me, Dan, your home that you have in Homedale, New Jersey, how much could you rent it for, you think? I couldn't tell you with a high degree of confidence what I think it would rent for. How is Joe Schmo on the street that's not in the housing industry going to give you an answer? And it makes up like 33% of the report, which is crazy. So why not flip-flop the weightings and use the hard data that you have for rents and but the imputed data at a lower percentage. So this is just in 2 seconds. They're giving you a couple ideas. And I know there's PhDs at the BLS, and it's probably a lot harder than it sounds, but clearly there has to be changes made because the margin of error has gotten worse, and it's such an important report. Now, listen, we heard from Austin Goolsbee today. He's a Chicago Fed president. He's a voting member. And boy, has he flip-flopped. And we're going to talk more about the Fed, okay, in a little bit. But he was
changed
somebody
on a
that
dime
was,
today.
He was one of the people that was like the most in favor of cutting rates. Yeah. In fact, he said, and this was not that long ago, he said the Fed needs to get to neutral, and he estimated neutral was 2.9%. Well, with where the Fed funds rate is, that would imply he thinks the Fed should be cutting 7 times at 25 basis points a clip. He also was very clear. He's not fearful of the inflation from tariffs because they're one-time price increases. They're going to be transitory, and imports only make up 11% of our economy. So now he comes out and he says we should, he's not committing to a September cut. He also said that he's fearful of the inflation from tariffs. And the one that really struck a chord with me is he said the labor market is solid. Well, how could you say the labor market's solid? I mean, the way he does is this. He says, well, the unemployment rate is at 4.2%. So let's just go through that for a second because you've heard of people trying to cherry pick data to like make their case. I'm going to give you a great example here. All right. So, okay, you don't want to pay any attention to the 35,000 in average job creations over the last 3 months in the headline business survey. Meanwhile, there's going to be more revisions and it's going to be lower than that. But there's 2 surveys within the BLS jobs report. The business survey where you get the headline job creation number and the household survey where you get the unemployment rate. The unemployment rate moved up in the latest report from 4.1 to 4.2%, but it was a hair from being 4.3%. Notice 4.248%. And you have to remember the unemployment rate's a ratio. Okay? It's the number of unemployed people by the labor force. Well, how are you just going to look at this and say, well, the unemployment rate's still pretty good and not see this report showed 260,000 job losses. And over the last 3 months, 863,000 job losses. Now, why has the unemployment rate not gone up more than you would have expected? Because the denominator, the labor force, they keep counting less people. Okay? Right. There's been an exodus of the labor force. So they're not counting them as employed or in the labor force, even though they're still breathing, they have a pulse. So that number is skewed, in my opinion. Now, listen, there's something called the U6. This number here, 4.2, it's called the U3. That's the unemployment rate everybody goes off of. The U6 adds back all these people that they're removing for various reasons, like, oh, I'm disgruntled. I haven't looked for a job in 4 weeks. So guess what? We're not going to count you as unemployed or in the labor force. It doesn't make sense to me. But anyways, the U6 has gone up to 7.9%. That's really indicative of like the true unemployment rate in the United States. And it's the second highest reading since 2021. So listen, I don't think the labor market's strong. And even if you wanted to cherry pick the 4.2%, which was almost 4.3, you've seen 863,000 job losses within this report over the last 3 months alone. So I think we're going to see the unemployment rate continue to move higher. I think it's going to go from 4.2, which is where it currently is, to 4.6 over the next 12 months. That will help mortgage rates and also continue to pressure the Fed to remove restriction and to cut rates.
Which brings the question I got to ask, why did we stop using the U6 rate in the 90s? Like, why did we switch from U6 to U3? I have people ask me all the time, and I give them the answer that I think is right, but I'd love to hear your take on that real quick.
So I'll be completely transparent with you. I don't 100% know the answer to that. Actually, the first time I've been asked that. And I didn't realize that they changed looking from the U6 to the U3 back then. But if I were to just say why, listen, there's been changes, and this could be pure speculation, okay? But there's been changes before to kind of fit the narrative a bit.
There you
better,
go.
Right.
So,
we changed our whole methodology on inflation, where they used to include things like home prices. Now they look at homes as a service after the 70s and stuff, right? Now they, the U6, I mean, if you're looking at the U6, it looks like the unemployment rate's a lot worse than if you're looking at the U3. So, right. It certainly would probably be in a lot of people's best interest and the markets in some cases to be quoting a lower unemployment rate. So I don't know the answer truly, but you could see why there could be some incentive to change the metric that you're looking at there.
Yeah, I think they began publishing. I looked it up while we were talking. They began publishing the U6 in 94 and then continued using, I guess so they never really switched. I should correct myself. They just favored the U3 over the U6.
Gotcha. Yeah, I mean, as long as I can remember, they've always favored the U3. They report on the U6, but the U6 is the real unemployment rate, in my opinion.
Fair enough.
So the Fed, right? The Fed, critical, important. The Fed didn't cut July 30th, but there was two dissenters, two Fed governors, Bowman and Waller. First time in 32 years you saw that went against the grain. One of the problems I see with our Fed, and it's different than, like, let's say the Bank of England, they always are like lemmings and they fall in line with the Fed chair or the general consensus. You rarely see dissenters. You have some of these people talking a big game, and then all of a sudden, Fed chair maybe, or, in the meeting that they have, they decide we're going to pause, and then everybody usually falls in line. And, you look at like the Bank of England's last meeting, it was like a 5-4 vote that they decided to cut rates. That sounds healthier to me. Like there's healthier debate, not usually with our Fed, but guess what? That changed a little bit with two dissenters at the July 30th meeting. And everything Waller and Bowman said, it's pretty in line with what we've been saying all along. But they were proven right. They said you can't believe the jobs data. They keep revising it. And sure enough, we're seeing that unfold now. And you want to get ahead of it, right? So the Fed, they all say this. Monetary policy has long and variable lags. What does that mean? Translation, if they cut rates today, it's not like tomorrow that filters through the economy. It takes a long time. So if you're trying to stave off a recession, if you're trying to stave off the labor market falling to hell in a handbasket or falling apart, you have to get ahead of it before it falls apart by looking forward. And boy, there was a lot of writing on the wall, a lot of signs, and they didn't do that. Now, listen, the Fed makeup is always critical, right? If you have a more dovish Fed, more hawkish Fed, what that means, a more hawkish Fed would be less in favor of cuts, more in favor of hikes. A more dovish Fed will be more inclined to cut rates, okay? So if you want to see rate cuts, you want more of a dovish Fed. Well, we know Jerome Powell has been a bit hawkish and very patient, very cautious. His term is up May of 2026. Now, Kugler was a Fed governor that was just replaced by somebody that Trump appointed, Stephen Miran. He was the head of the CEA. And he also is somebody that's dovish. Now, it's unclear if he's going to be sworn in before the September 16th and 17th Fed meeting, which is the next meeting. They vote on the 17th. It's in probably the administration and his best interest, if they want to see a greater chance of a cut and such, for them to swear him in. But we don't know if that's going to happen. So it could be Kugler voting or it could be Miran. But Kugler, she resigned early because she wants to go back to teaching at Georgetown, and she wanted to get there before the school season started. Now, Bowman, we know, is dovish. She's going to vote for a cut probably every meeting the rest of the year. Waller, same thing. Goolsby, boy, when I made this slide, he was like a super dove. But now, it's questionable what he's going to vote for. He seems like he's really flip-flopped and done a complete 180 with some of the things he said. I heard Musalem here speaking today. He said some reasonable things. But listen, I think there's a great chance that we're going to see a Fed cut September 17th. I think it's baked in to I think the market's pricing in a greater than 95% chance. There's actually been people like Treasury Secretary Scott Bessent who have said maybe we should do a 50 basis point cut because we should have cut July 30th. And if we saw the jobs data beforehand, we would have. But since we didn't, let's make up for that. Yeah. I don't think that's going to happen. Okay. Quinn, it was such a pleasure being with you, brother. I have to jump.
Yep. You got it, man. Hey, thanks for being on the show as always. Again, guys, if you like what you're hearing, please share this podcast. Check us out on Apple, Spotify, and YouTube at What's Your One More for all the charts. Thanks again, Dan, for being on the show. We'll see you, buddy. Yep. All right, buddy. Bye.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one